at this point in time, we're looking towards what might happen with the federal budget in May. And, of course, there'll be a lot of speculation to and fro as to what the government will be doing in the budget, what cuts and what funding will be made available for various projects. To talk through issues that we should expect in the federal budget, our finance guy, Gavin Martin, the founder of Cornerstone Wealth, is back with us. Hello, Gavin. Welcome back to 2020.
G'day, Neil. Nice to be with you again.
Gavin, it's always a time when things can be uncomfortable, particularly if you're on the losing end of some of the speculation that's happening about the budget. Who are likely to be the big winners and losers? And perhaps let's start with the losers when it comes to this coming federal budget.
Yes, well, there's a number of announcements that have been made in relation to superannuation prior to the budget, and I think because the federal government had flagged that they're going to make some significant changes within the superannuation area, the uncertainty was causing problems, and so they've come out and on the 5th of April this year announced a number of the changes. Now, they may not be all the changes, but they've announced a number of the changes that they're proposing in relation to super, and some of the changes that are not going to be particularly appealing for people on the age pension. So there are things like deeming rates are being extended to account-based pensions that haven't been in the past. Although there are some concessions or some positives in that if you're over 60 from the 1st of July, we'll be able to access a higher superannuation contribution rate. A concessional contribution rate will be increasing from $25,000 to $35,000. So there's a range of initiatives, but a lot of them really are focused on being able to get the budget back to surplus, so trying to increase the take from government's perspective.
Of course, the big focus that the media has looked at, of course, has been this 15% tax on pension earnings beyond $100,000 a year in superannuation, and for most of what the government's saying, that's going to hit only a small percentage of people. But is there a flow-on effect from those who are going to be affected by that change?
Yeah, there shouldn't be too much of a flow-on effect. Now, the government estimated that particular strategy, so this is, as you said, where if you've got a balance of potentially $1.5 to $2 million, the government's saying $2 million, but it depends on the earnings within the fund. If you're in that area earning $100,000 within your pension fund, then you're going to start to be taxed at 15%, whereas there was no tax on it previously. Now, they said on their estimates that would only affect about 17,000 people or funds, but if you assume a higher level of earnings, which is potentially what would happen, it's going to affect probably double that, so more like 34,000 people. But still, it is the higher end of the market, and if they're wanting to not put offside their main constituents, then they're targeting the right segment.
And of course, some are saying, well, the people who are earning that much money on their superannuation are not likely to be Labor voters. So it really is a Labor government initiative to actually bring in this tax, and there's been a lot of people critical of it.
Yeah, I don't think there would be too many people in this case, but a few funds have highlighted the issue that sometimes people receive compensation payments. So there might be a disability payment or a death benefit that's been paid into their super fund, that it might be several $1 million because it's substituting the earnings of the main breadwinner who died or became totally and permanently disabled, and they might be impacted by this particular tax or additional tax, whereas they shouldn't potentially be in that situation. They're actually just being compensated for foregone earnings because of a catastrophic event. I've
heard too of the idea of short-circuiting the whole process, finding loopholes by spreading your superannuation earnings across a number of different superannuation accounts. Is that one area that the government would need to be concerned about?
Yes, definitely. They're not 100%. I'm not 100% clear exactly yet whether they'll make it per account or per person. I would most likely think that it would be per person. So if you had two pension accounts, and they both earned $50,000, that you would fall into this category of being taxed at 15% rather than zero. But there is a strategy where you can actually divide superannuation assets between two people in a couple. So a couple of years ago, when they eliminated what we call reasonable benefit limits, reduced the need for you to have even account balances, so the same amounts as in super for both spouses. But this initiative, particularly if you're getting to those higher balances of $1.5 million, then having equal balances will mean that you'll access two of the $100,000 thresholds and therefore potentially reduce your tax. We're getting back to those times again.
Gavin, you mentioned the changes to deeming rules for people who are on the aged pension. How is that going to affect aged pensioners?
Yeah, so deeming rules are the amount of income that it's assumed that your financial assets earn. So you might have, for example, $100,000 sitting in the bank, and it might be earning next to no interest because you've just got it in an at-call account. That Centrelink, for aged pension purposes, will assume a certain level of earnings on that. Now, assets like money in the bank are deemed. Other assets like investment properties are deemed. But at the moment, if you've got money in an account-based pension, so you've got money in super that's in pension phase and drawing a pension from it, those assets currently aren't deemed, so they're not assumed to earn a particular level of income, and so it can provide a higher level of age pension than if you've got the money sitting in the bank in some circumstances. Now they're going to change this so that age pensions are deemed, which then will most likely reduce the amount of age pension payable to a lot of people. So yeah, it will have a large impact. That's proposed to happen from the 1st of January 2015. So if you're thinking about setting up a pension or got the potential to set up an account-based pension before that time, then it'd be well worth considering it.
Well, there certainly are some changes on the way, and for those who have significant superannuation savings and to aged pensioners, when it comes to those deeming rules, there'll be people looking very closely at what the Treasurer will bring down with the May budget. And just a note too, that if there are concerns about those sorts of issues, the advice through Gavin Martin today is really a general advice, and if there are specific circumstances that need to be taken into account, then you should talk to your own financial advisor. In saying that, I'll point people to your website, Gavin, at www.cornerstonewealth.com.au. Gavin Martin, always a pleasure. Thanks for talking to us today here on 2020.
Yeah, great to be with you, Neil.